Okay, nice. Do we have something from the previous seminar to solve? Because I don't remember. Yeah, probably the last exercise. Okay, can you see my screen?
Yes.
Mm-hmm. Okay, so who can show the last exercise from the previous seminar? Can you raise the hand, please? Aygul. Okay, let's look at your tab. Or you need to demonstrate the screen. Okay, so I'm on your tab, so you can explain. Aygul, are you with us? Okay, guys, can you hear me?
Yeah.
Yes.
Okay, well, okay, let's talk to Alisa then. Alisa also raised the hand.
Yes, I'm ready
Oh,
to comment.
did you hear me? Was something wrong?
Aygul? Yeah. You probably had some problems with the microphone.
Yes, maybe there was
Okay.
a problem.
So,
So
Alisa, I
just
apologize, but Aygul was the first, so let's look.
yeah, we just needed to divide the forecasted dividend by the expected return, so and get the current stock price.
Yes.
Which is 83.
Which is, yeah, here. Okay, so that's clear, I think, for everybody, because that was what we were doing during the whole seminar. But what about the second part? It's more interesting.
Yes, in the second part, we need to calculate the expected dividend growth. So to do this, we multiply the blowback ratio by the return on equity.
Yeah, that's right.
Yes, and we get the dividend growth. So then we can calculate the forecasted dividend.
So how we calculate the forecasted dividend?
Then we take the dividend growth and multiply that by the blowback ratio, I think.
Yeah, but you have another formula here, actually.
Yeah, I'm sorry.
Okay, maybe someone can help.
Because I was doing this.
What exactly?
Well, maybe Alisa. Alisa, you also raised the hand.
Yes, I can show my solution, but I think it is the same or...
Yeah, so how we should calculate the forecasted dividend in the second case? So
forecasted dividend, we should take a forecasted dividend 10 and subtract 10 multiplied by 50%.
Yeah, and why should we do this? So what is
Um,
changing here?
Because we have a plowback ratio 50%, it means that our forecasted dividend should be less by 50%.
Yeah, so what will happen with the money, like with other 5? So we have 5 in dividends. What will happen with another 5? Like with so we had 10, yes, in the beginning. Now we have 5. Where is the another 5 rubles? Where did they go?
So
It
I
would
think-
be reinvested, maybe.
Yeah.
In the firm.
Yes, you're absolutely right. Okay, and then we just calculate the share price. As always, dividing dividends by the expected return minus the growth rate. Yes, using our favorite formula. Okay. Well, with some of other groups, we had realized that students have some problems with understanding the formula for expected dividend growth. So can someone please explain why we multiply plowback ratio on current return on equity? So what's like how this formula can be derived?
I can try to do it. Actually, I think that expected growth of the firm depends on how many money we reinvest in our firm. So if we put all the money in dividends, then we don't have growth at all, and it is equal to 0. But in this case, we reinvest money, and the percentage of the growth of the firm depends on the amount of money which reinvested in our firm, and the percentage of reinvestment is a plowback ratio, which is equal to 50%. That's why we can calculate expected dividend growth. So we just multiply these two numbers and understand how what ratio goes to our firm again, and it is exactly the ratio of the growth of our firm. I don't know whether it is understandable or not, but I think that it is like this somehow.
Yeah, okay, for me it's quite understandable, but let's show it also on like some numbers. So how this formula is derived for all of the students to be on the same page. So, for example, we have year 2, oh, I'm sorry, year 1 and year 2 here. So in year 1, we have some assets and some equity in the balance. Let's say that we have 1,000 in equity. So how much we will have in assets here?
Oh, 1,000.
Yeah, 1,000. Okay, sorry. So we have some earnings. Yes, and given that the return on equity is 18%, we have like our earnings will be equal to this number, right?
Yes.
So our return on equity multiplied on equity. And if, for example, all the earnings will be paid as dividends, what we are going to have in the next year in equity?
1,000 minus 180.
Why?
Maybe because
No, I think just 1,000. Because
just
we
1,000.
have earnings and we pay well, as dividends.
Yeah, and assets also 1,000, yes. So the next year earnings will be, let's calculate them.
Yeah.
18 again multiplied on 1,000. But if we, for example, reinvest 50% of these earnings, so we will pay dividends. We'll pay dividends of this multiplied on this, yes, and the same money will be reinvested. Yeah. So what are we going to have in this case in year 2 in equity and in assets?
1090.
Yeah.
In both cases, yeah.
Yeah, so we will have higher earnings, you see, in this case, given that the return on equity will be the same, right? And if we again calculate dividends here, if we again take the earnings and pay 50% of them in dividends, we're going to have this value. Yeah, so if we calculate the growth, the dividend growth, it will be 9%. So the same 9% that we have here. So that's why we can just multiply the plowbook ratio and current return on equity and get the expected dividend growth. So is it clear for now? Because yeah, we had some problems with other groups, yeah, and so is it clear now for you?
Yes, thank
Yeah.
you.
Okay. Well, let's then move on and start our today's work. Okay, so we are going to talk about risk and return. And let's start with the small warm-up. So I have some statement here. What is said here? Playing the stock market is like gambling. Such speculative investing has no social value other than the pleasure people get from this form of gambling. So how can you react on this statement? So do you agree with this or do you disagree, and why? So you can raise the hands, I think. Okay, Aruzhan.
Well, I guess there is no right answer, right?
Yeah.
But just opinion. Well, in my opinion, I guess there is social value. Why? Because investing into some companies makes them, well, they will have some finances in order to operate, in order to maybe develop some new products and make your, not specifically your, but overall lives of people on the planet better. Who knows? But I guess I would agree with the first sentence because, yeah, in some way, for some people, it's like gambling because there, if I'm not mistaken, there are even such negotiations. I don't remember how they are called in English. When you also make bets, like whether the like assets will, not assets, but stocks will
You
be.
mean options? Options, yeah. Like опционы.
А вот
No?
это, по-моему, фьючерс.
Yeah,
Когда вы ставите
futures
ставку на то,
also,
что
yeah.
повысится ли акция или нет. Вот. Yes. Okay, I'm
Yeah,
sorry.
yeah.
I guess this is some sort of gambling because you are becoming addicted to that sort of earning money, I guess.
Yeah,
Yeah.
maybe. Okay, maybe some other opinions.
I would say that it's not only the revenue for the companies, but also for people. Otherwise, probably people will not earn money this way. Maybe in Russia we don't, like, not a lot of people do this, but in other countries a lot of people earn money on investments. So I think that that it's not only gambling but the way of revenue and profit.
Yeah, thank you. Diana, you also raised the hand. What do you think?
I think that I think that it's kind of gambling, yes, because people do it for their own value, for their own pleasure somehow, but actually doing these actions, very egoistic, maybe one, they improve the state of the companies, which gives value for many people, as Arjan said. So maybe they do it personally for themselves. The majority of people, I don't say I don't tell nothing about investors who really cares about the future of humanity and something like this, about our environment and nature. But for the majority of people, they just do it for themselves, but they improve the situation of the company, which sells goods or services needed to the major part of people. So there is a social value too, of course.
Yeah, well, nice argument. Well, I don't think that actually this, like, buying stocks on the secondary market, like, directly influence the state of the company, yes. But still, yes, it directly influences the wealth of the shareholders of this company, yeah. And they, for example, can sell some part of the company for more money and and invest the money into the company and etc. Okay. Yeah, I think that you are all right. Well, what you haven't said is that, for example, stock market is more like gambling in the short term. Yes, so like for the people who trade, who can, for example, buy some shares, some stocks now and sell them in 5 minutes, I don't know, because the price fluctuates and etc. Yeah, but if we talk about some long term, it is more about some investment, some like saving money, yes, from inflation and getting some profit on this money. Yeah, and actually, in the long run, the stocks tend to grow. And actually, one other important argument is then when we say gambling, it means that we have, in English, it's called a zero-sum game. Yeah, so all the cash flows that are invested in some, let's say, project, yeah, they are redistributed between the investors. Yeah, but here, when we are talking about stock market, the stock market tends to grow. So the wealth of every investor in theory can be can grow. Yeah. Okay. Well, let's then make some exercise. Let's go to the spreadsheets and I will upload the tasks. 1 second. Well, give me 1 minute, please. Okay. Well, okay, so the first task is about some stock, which has historical data about the returns. And the returns for periods 1 till 6 were the following: 27, 12, and etc. in percent. So let's start with a very simple task and calculate the arithmetic mean return and the geometric mean return, which is actually, I can help you a little bit, which is actually equal to CAGR. Yes, in this case, if we talk about years. Okay, so who will be the first? Please raise the hand. Diana, are you ready, or you just forget to lower the hands?
Yes,
Okay.
I'm just forget, sorry.
Okay. Cool. Daria, you have a question, or you are ready to show the solution?
I can try to show the solution.
Oh, you are very fast. Okay, so let's wait for a minute and then let's look at your solution.
Excuse me, may I ask a question about, you
Yes.
said that geometric mean return is Kaggle, but Kaggle we use prices and not returns. Can we just use geom mean? Or...
Yeah, you can. And you should use the geometric mean. Yeah, but actually it will be equal to Kaggle in this case.
Okay.
So, yeah, but you say that we use prices for Kaggle, yeah, but we actually can say, for example, that in period 1 the price was 1, and then calculate how the price changed during this period, and then calculate Kaggle. Yeah. Oh, and I suggest you not to use the formulas, like not the formulas, but the functions in Excel, like среднее геометрическое, because it can give some misleading results.
But can we use simple functions like product or sum?
What do you mean by product?
Multiplying the values.
Like the star? Yeah. So, well, I'm talking about the function. So we have in Russian it's Sergiom. In English, let me.
Geom mean.
Yeah. So it won't give right results in case of these returns. Because, like, okay, let's look in the formula and then let's discuss why this function doesn't work here. Okay, Daria, let's look at the first one firstly. A second, let me find you. So what about the first one?
The first one is just average, or we can sum up all the returns and divide this number by the number of the returns.
Yeah, so here the function
Average.
Like, yeah, it works, but we can do it like this. So sum all the values and divide it by 6. Yeah. Oh, that's nice. Okay, what about the second one? So
I
you
used-
here,
Yep,
yeah, you use the function.
geomin, but if we want to find it like Kaggle, and we use like these returns, we will have the negative number. So
Why will we have a negative number?
I tried to count it like we did with like prices, but if we do this like we did with prices, we will have minus 257 or something like this. Maybe I just forgot.
Okay.
I can try maybe if it's necessary.
Yeah, let's look at your solution. Sorry.
Try to count it again, but I had the negative number when I did it.
Well, it's strange. Okay, let's look at Konstantin's solution and then. Okay, yeah, so you have the same formula here. Yeah, but actually
I can try now calculate it manually. I actually at the moment try to calculate it. Just use power.
Okay, let's pay some time for it. Try to calculate it. So actually what we're going to
yes, slightly different result.
Yeah, and it's more similar to the right one. Yes, I guess that's right. So what we're going to find here is like how on average our stock grew during these 6 periods. Yes, and we should like incorporate the concept of compounding here. So we cannot just take the geometric mean of these returns. So one solution is to calculate it like Kaggle. So calculate the, like Konstantin did here, calculate the price. Yes, so let it be here 1, and here it will be 3 and 33, right? And then calculate the geometric mean return as a compounded annual growth rate. Yes, so you have the formula for that. If we want to use the formula of geomin, we can take not the returns itself, but 1 plus returns. Yeah. Then we can use, this function, but we should subtract 1. So here we added 1 to every return. Here we subtract it and get the result. Yeah. Or calculate it as compounded annual growth rate using the forecasted prices. So the price of the ending period divided by the price of the first period. So here it's not the first, but 0 period, yes. And in the power of 1 divided by the number of periods and minus 1. So that's the formula for compounded annual growth rate. Yeah. So is it clear?
No, yes. But why? Oh, okay.
So yeah, if you have questions, let's discuss them. That's important.
Why we have such difference between just returns and how to say it? The whole return with 100%.
Well, actually, this I would say that this formula, if we just make the return. So what is the geometric average? If we like
in the right cell, I tried to calculate it manually, but with formula product.
Yeah, so it's the product of this of these returns, yes, in the power of 1 divided by the number of periods. Yeah, so it's actually make no sense in the calculations because we have no Because actually, if we want to calculate the return and how the price changed, we would use these ones. So we will use 1 plus 27%, 1 plus 12%, and etc. Yeah, so I would say that this calculation doesn't make any sense. So I suggest to use the formula for compounded annual growth rate. It is a very useful formula for every, like, you will certainly use it in your professional activity if you work in some fields connected with the finance. Yeah, so that's the most used maybe formula in finance in real life. So I suggest to use it, and you will never like get wrong results using Kaggle formula. Yeah. So the only maybe disadvantage is that we should calculate some kind of prices here, but it's not very tough to do it. Yeah, but we can use this actually, this approach also, but don't forget to add once and then subtract 1 in the end. So we are just like multiplying these numbers, we are actually finding the whole return. Yeah. So if we multiply them all, that's the like 3 and let's make 10%. That's the whole return that we get for all the periods. Yes, from period 0 to period 6. Yeah. So our stock price grew by 333%. So, and we can see it from the price. So it was 1, now it's 3.33. So that's the return for the whole period, or holding period return, as we call it during this course. Yes. And then we just find the average of this, and then we just find how on average the stock should grow to get to give us this return in the end. Yeah. So something like this.
May I ask you, like at the very beginning, you have written that that was written CAGR, which is compound annual growth rate.
Yeah.
But can we say that this is CAGR if it is like, if I'm mistaken, holding period return, right?
No, this 300% is holding period return.
Mm-hmm.
And this is compounded annual growth rate, or the geometric mean return. So on average, the stock should grow by 22% to give us 333% of return of holding period return in the end.
Okay, thank you.
But we shall subtract 1, no? From HPR.
Probably.
Because it's gross, and we shouldn't conclude the first 100%.
Yeah, you're right. So we, for example, we take 1. The price for year 0 is 1. Yes, and we multiply it by 1 plus this growth rate. Yeah, you're absolutely right. Yes, so to find the holding period return, we again should subtract 1 from here. Yeah, I'm sorry. Yeah, so yeah, holding period return is not 300 but 200%. Yeah.
Excuse
me.
Let's. In HPR, which function you use, because it's written in rational and content stuff?
I'm sorry. It's well, I don't know if I
this is the product.
Yeah. product, yes, but it won't work here because my computer is. But let's try. Yeah, that works. I'm sorry. So it's product. Yeah, like this. In English, that is product. And for geometric mean, let's find it. For example, for geometric mean, we use this, right? Yeah. Geomin. And for this, well, who knows how this formula is called in English? So it's average. Right?
Average.
So for the ordinary arithmetic mean, we use the function average. Oh, I'm sorry. Okay, well, let's move on. Look at the following exercise. Okay, let's look at it on the slide firstly. So I have prepared the data for some stocks. One is for Lenta, you know, the Russian retailer, yes, and one for VTB, Russian bank. So we will have here adjusted close price for December 18, December 19, and December 20, and December 21. Yeah, and we have the close price for both of the stocks. So let me now copy the task. So actually, what we should find is actually everything. So starting with holding period return. So starting with holding period return, compounded annual growth rate, arithmetic average return, variance of the stocks, and the standard deviation for each stock. Okay, so I think that you need some time to do it. So that'd be like, I don't know, 5-6 minutes. And then let's try to discuss. So in case of annual returns, of course, we won't have 4 values, but 3 values because we have 4 periods. So we have 3 values. Remember, we did such a task with Tesla on the first seminar. So we just find the growth between the years. Okay, so I will be silent and then let's discuss.
Excuse me, may I ask a question about the task?
Yeah.
Can we calculate variance with function variation? And what type of function should we use, sample or population? And if we use sample, can we say that is a part of the data set, so we use sample?
No, here we use the function for population. Yeah, because
and in home task also.
Yes, yeah, because when we are talking about the return, for example, here we will have 3 values here and 3 values here. That's in this task, that's the whole population of our data. Yes, so we do not take some sample, yeah, but we are talking about the whole population here. So the only difference between the formulas is when we are talking about the sample variation, we divide the formula by the number of observations -1, because it was proved by some mathematicians and statistics that it is a better estimate of the whole population variance. Yeah, but here we should use the formulas for the whole population. Yeah, I had a suggestion to firstly just for one stock at least to calculate it by hands. Yeah, so by definition. But of course you can then use some but of course you can then use formula which is called variance, yes, in English. Let me check it. So in English it will be var.p. Yeah, in Russian it will be gisp. So Konstantin, you are ready? Let's discuss.
Well, yeah, I just finished my calculator for manual variance.
Okay, let's start with the beginning.
Yeah, okay.
Okay, so
firstly, we just calculate annual return by extracting from the today priced the year before price and extracting 1.
Not extracting, but
dividing and then extracting 1. Yes, it's working for both stocks. And for calculating HPR, we use ending value and beginning value. And for Kaggle, we use compounding average price.
Yeah, so again, we divide the price for the last period on the price for the first period, and in the power of 1 divided by the number of periods between them. Yeah, so why do we use 3 in this case?
Because we have 3 periods.
Yeah, so we are calculating not the periods, but the
returns.
Yeah, the links between periods. Yeah, so 1, 2, 3. Yeah. Okay. And -1. Okay, that's understandable.
So for arithmetic average, we just use formula average, and we took all returns that we have in both stocks.
Yeah, so in English, this formula will be average. Yeah.
But I have formulas in English.
Okay, but we do not see
Okay,
it.
I explain from my tab and not MS Teams. Okay.
Okay,
For
but I'm
variance,
showing to other students. So, but here I
okay.
have in Russian. Maybe I should switch to English. But okay, maybe for the next seminar I will switch the formulas to English.
For variance, we just used variation.p formula, and for standard deviation, we just use square root or also standard deviation.p. I tried to compute it manually, but I have different results.
Okay, so for the standard deviation, we just use the square root of the variance. Yes, in Russian it's function korень. In English, does it look like this or not?
Let me see.
Yes.
Yes, square root.
Okay. Okay, well, I don't think that we have time today to calculate the variance by hands, but you can like practice it at home. So it's actually, it is not very tough. So we just.
But I don't know why I have different results, because I just calculate the error from the actual return and average, then square it for variance and divide it by number of observations. And then just sum it. But for LNTA, I have, I don't know, that result and here is it.
Well, so you take this from arithmetic average. Yeah, that should work. I don't know.
Maybe the
So maybe some problem with the brackets.
no. So I don't know what's the problem. Well, okay.
Okay, so well, let's practice it at home because today we have something to do. Okay, so we have calculated some parameters of these stocks. Yes, returns, the variance, the standard deviation. Now let's imagine that we are going to buy these stocks and to create the portfolio of them. So so imagine that you have 100,000 rubles, and in 2018, sorry, you will invest 60% of your assets in in Lenta, and the remaining part in VTB. So how many stocks of each company will you buy? It's the first question. And then please find the return, standard deviation of this portfolio. Yeah. So, okay, let's again have some minutes. But first, do you have any questions about this task? Maybe we should discuss something in advance. Okay, if no questions, that's okay. And while you will be calculating, I will try to calculate the variation using like by hands.
If I found a mistake, I forgot to fix the cell with arithmetic average.
Okay. Okay, Konstantin and Aruzhan, did you forget to lower the hands?
Yeah.
Are you ready? So here on the tasks tab, I put the formula for variance for Lenta. Yeah. So you can copy it to your cell if you have the same rows and columns here. So if you just, well, if you copied it into this line, yeah, that should work. So just how it should be calculated manually. Well, okay, so I have changed my language here. So now I can show the formulas in English. Okay, so maybe some suggestions how to solve this part of the task. Konstantin, let's look.
But maybe someone else wants to show it. Well, I'm in process to calculate variance, but
You're in, okay, maybe someone else is ready also.
I may show initial calculations, but I don't know how to go further, unfortunately.
How to what?
Like I have done like initial calculations, the number of stocks to be purchased and so on, but I'm not sure about the HPR of the portfolio and so on.
Okay, let's do it step by step. Let's first look at the number of stocks. Okay. Well, let's start again with the share and the correlation coefficient. Yeah. So how we calculate the correlation here?
Oh, just using the formula correlation, I guess.
So yeah, and we are taking annual returns of these two stocks as the arguments for this formula. Yeah.
Yeah, we'll need it for our variance, I guess, and standard deviation.
Yeah, of course, we will need it here. Okay, how to calculate the number of stocks to be purchased of Lenta and VTB?
So I
Sorry,
simply
again,
multiply.
can you do the correlation coefficient again, please?
So we use annual returns, as arguments for this formula. Yeah, but also we can actually calculate it by hands if we want. But let's use formulas because like in real life we're going to use formulas in Excel. Okay, can we move on?
Thank you.
Welcome. Okay, so how to calculate the number of stocks to be purchased?
Well, I simply multiplied. Well, firstly, I found out what is our budget for Lenta separately, multiplying budget by the share of Lenta. Yeah, and I divided it by the price. Yeah, the final price, which we see at the 3rd of December 2021.
So by this price, yeah. Yes, you are right, but if we look at this number like here, we are going to see that it's not integer number, yeah. So we cannot buy 298 shares and some parts. Yes, we can buy only integer numbers of shares. So how can we transform this number into integer?
Can we just round?
Yeah, but round to which? Round high or round low?
Lower, because then we will have some sort of uncertainty if we will take higher.
Yeah, but actually here we have money only for 298 stocks. Yes.
Yeah, because we have budget constraint.
Yeah.
Yes. Oh, yeah. Then I did it we shouldn't just remove zeros in the very end. Yeah, I guess we should use the formula round, if not mistaken. Yeah, 1 second.
So it's actually called round down, if I'm not mistaken, yeah?
I guess mine is in Russian, but okay, 1 second, I will try.
In Russian, it's,
Oh, yeah, finally.
yeah, like this. Yeah.
Excuse me, but what price we take to calculate the number of stocks to be purchased? We should take the first price now.
Yeah. That's also correct. Yes, because we are purchasing it in the beginning of the period. Yeah. So
Oh,
can we?
I'm sorry. Like,
Yeah. So now that's, yeah, that's what I have also. So we are going to buy 251 shares of Lenta and this big number of shares of VTB. Yeah. Okay, how to calculate actual shares in portfolio?
I guess we should just multiply. 1 second.
So we haven't actually spent all this 100,000 rubles on the stocks, right? We spent some, like a more little part. So the actual shares should change a little bit.
Yep, 1 second.
So, okay, and who has the calculations of shares, of actual shares in portfolio?
I have, but only calculations about actual shares. So
Okay, let's look. Yeah. So how you got it? So can you please explain?
well, first of all, we need to multiply the number of stocks we have by its price initial, and then by the budget constraint we have. So divided by 100,000. Well, and that's how we can calculate them.
Okay. Well, maybe some other suggestions. Does everyone agree with that? Well, as I have said, we haven't spent all this 100,000 rubles on the stocks, right? So why should we divide by 100,000? Maybe it's better to calculate how much we actually invested in the portfolio.
Oh yeah, so we need to change this budget constraint and then divide this what we have calculated before by the new number.
Yeah. So we know how much we invested in Lenta and we know how much we invested in VTB, right? So we can just sum up these two values and get the actual investment, yes, in portfolio.
Can you check it? Like, it's pretty similar numbers, if I'm not mistaken.
Yeah, so we just multiply the number of shares on the price of share for Lenta and the same for VTB. Yeah, and then just sum up this price. Yeah, and now we are going to have the correct shares in portfolio. Yeah. So is it clear for everybody?
Yes.
Mhm. Okay. Well, what's next? How to calculate the holding period return?
We should multiply the fraction by the HPR of separately Lenta and VTB and
Yeah.
sum it together.
Yeah. Well, maybe someone has has done it yet. Konstantin, are you ready with that part?
I have done the calculation, but I haven't done variance and standard deviation.
Okay, yeah, so the holding period return, yeah, it's just the weighted average sum of the returns for these two stocks. Yeah. Does everyone agree?
Yes.
Okay. Well, let's move on. And what about the variance of the portfolio? Who is ready with that?
I did it, but I need to count actual shares for VTB, and I can show it because I didn't.
Okay. Okay. So how we should do it? So you have a very big formula here. Can you please comment on that?
Well, this is a formula from the lecture. The first step is to square root the actual shares, or to возвести в степень.
Make it in a power of 2. Yeah.
Yep, the actual shares of the first of Lenta, and then multiply by the variance in the power of 2. Then to sum with the same did with VTB, and then to add 2 multiplied by actual shares in each portfolio, multiplied by variance for each stock, and then to multiply by the correlation coefficient.
But actually here in the last part, should we use variance or standard deviation?
Oi.
Let's find the formula. Yeah, so that's the formula we're talking about. Yes, so we should use variance here.
Yep.
So can you please change it to variance?
Ой, я не на то нажала, да?
Oh, I'm sorry. Can you change it to standard deviation? Yeah. My English. Yeah. So here to find like the last part of this formula, we use here standard deviations, not variance. Yeah. So it's without the square here. Oops, something happened.
Значит, надо
Yeah, that's That's similar to the correct answer. Yeah. So the variance of this portfolio will be 0.20. And here we can like actually compare, yeah, the variance of the portfolio with the variances of like of the stocks itself. Yeah. If we transform that to percent, for example, yeah. So we can see that the variance of Lente and variance of VTB itself are higher than the variance of the portfolio. Yeah. So that's how portfolio theory works. Okay, and what about the standard deviation? How we find it?
The square root of variance.
Yeah, we just use the square root of variance. And again, the standard deviation of Lente and VTB themselves are high, and the standard deviation of the portfolio is quite low. It is because we have the correlation coefficient like close to -1. Yes, so we can see that with the like when VTB grew, Lente fell, and vice versa. Yeah. So if we put these two stocks in the portfolio, it will be like it will have very, very little risk. Yeah, and actually we also can compare the holding period returns, yes, with Lente and VTB themselves. We have negative for Lente and positive for VTB, and we have something in the middle for the portfolio. So it is not like that, like as big as the return of VTB, but given that we have a very little risk, this return is quite nice. So it's not actually negative as Lente. Yeah. Well, so that's how portfolio theory works. Yeah. And probably you will have something similar on your midterm. So please remember this formula. Probably you will need it. I cannot tell you what will be on midterm, but probably you will need this formula. Okay. Well, let's try to solve another exercise. Well, we actually have 2 exercises for today more, but let's do at least one. Yeah, so it's very simple. We have 2 stocks. Oh, I'm sorry, we have 1 stock and some information about market return. Let's say it's S&P 500 index. Yeah. We should find the beta for the stock A. Yeah. Okay, let's do it, then discuss, and then finish our seminar. Okay.
And may I ask a question about midterm? Can we use a formula of correlation, or we should calculate it manually?
well, again, on the midterm, you won't need to show us how you calculated. Yeah, you will like write the answer in the box, and so it will be in electronic format. So actually, you can use any formulas.
But lecturer said us that we shouldn't use, for instance, NPV formula. We will have only the spreadsheet without any formulas, where we can just make sum or product, maybe, as lecturer said.
Okay, I can ask him, but actually, I think that was about that you like cannot use formulas like written. Some like you cannot use this slide. Yes, so you should learn the formula or actually know how that works.
I think it was said about the homework that some formulas that are included into the Excel can't be used because it's better to calculate some things manually, but not about the midterm, as I think.
Yeah, I also think so.
Rewatched all the lectures, and probably it was, maybe it was on the 6th, this one I didn't watch.
The last lecture.
Okay, let me ask Viktor Valerievich about it.
We will have some instructions before midterm. Maybe here we'll be writing something about the formulas of Excel.
Okay, I will check this question and
Okay.
I will write the answer. Okay, what about, okay, here I also upload in the homework. Actually, this task is somehow correlated with what we have done in the previous one. Yeah? Just to train yourself again before the midterm. Yeah, and actually, please also look in the presentation because we had here, or I think we can discuss these questions maybe on the next seminar. Okay, let me also put it in the spreadsheet. So because today I have planned to do a little bit more. So please, you can look at these exercises at home, and if you will have some questions, let's discuss them on the next seminar. Okay, well, what about this task? So who can show how to calculate the beta?
So, if nobody else wants.
Yeah, because our time is running out, so let's talk to you. Daria, okay. I'm here, so you can show something.
So the first step was to count average return by the formula average. For market return and for market and for stock A. Then to count variance by using VARP. Then to square root this number. The next step was to find correlation by using Corel. and put any market and stock A.
Yes.
The next step was to find covariance, which is counted by multiplication correlation and standard deviation for market and for stock A.
Yeah, actually we have standard deviation here, so we can rewrite it.
And the last step was to find beta, which is counted by dividing covariance with the market by the variance of the market.
Yes, and again we have, so we can do it this divided by the variance of the market. Yes. Oh, so 1 second.
Covariance.
Yeah. Okay, so beta is usually expressed in numbers, not in percent. Covariance actually also, but we can use percent or number form. Yeah. Okay, so a very simple calculation. So Daria, what is shown by beta? That would be the last question for today's seminar. So what have we calculated?
If I'm not mistaken, it's the change of stock price for each 1%, something like this.
Yeah, so for example, if a market price will change by 10%, how much will the stock price change?
Beta multiplied by 10.
Yeah, by 9.3%. Yeah, so you can find this the explanation here. Okay, well, again, I'm sorry for the delay of the seminar. Yeah, so I know that you have a break here, but again, just I want to stress your attention that the homework. Yes, so please look at this exercise. It's quite simple. You won't have any problems with that. Just to train again for the midterm and look at the questions from the seminar presentation. I will upload the presentation on Monday. I don't think that you will need these questions for the midterm, but still look at them and we will discuss them in the beginning of the next seminar because they are quite important. Okay, well, so I hope that all was clear for you. I know that now we're turning to more difficult calculations, but actually they can be used. They can be done by formulas here. Yeah, but it's also important to know how to do it by hands. So in the solutions, I will upload. So for example, here variance is calculated by hands, and somewhere I will upload the correlation calculated by hands. So also look at it because it's also important to understand how these concepts, how these values are calculated. Okay, well, so I think that's all for today. I wish you good luck on your midterm and see you next week.
Thank you.
If you have some questions, let's discuss them.